Hey Sam, sorry, I just wanted to ask.
Yeah.
A couple of times now, we obviously can't invest with our subs into cryptos. You guys have named a couple of mining companies. Would you mind just giving me the names so I can have a look into them?
Yeah, the one I use is ARB, A-R-B.
ARB.
Yeah,
Okay.
so I'm playing with ARB at the moment personally.
Okay.
In fact, I'm just having a look at it. And one of the things that I've spotted with ARB is that it has a bit of a lag. So when Bitcoin moves up, a few days later, ARB will follow it. And then
Yeah, you mentioned last week.
yeah, and then there's that, and on the flip side, when Bitcoin falls down, ARB normally carries on going up for a bit, and then it falls back down. So yeah, I found it pretty handy. At the moment, I'm looking at ARB on my other screen. It's only gone up 3% today, but it should start popping up now that Bitcoin made a rally to 62. So
Yeah, because I've most of mine is still in Andy Craig's fund, which has served its purpose
Oh,
while
dear.
things were going hectic. But at the minute, it needs to get out of there. So
yeah.
thank you very much.
Yeah, no worries. Yeah, it's a shame. I said a few years ago that that fund wouldn't perform very well because it had some inherent flaws with it, and that's one of the reasons Andy and I fell out. He just didn't agree with, I was just being straight like I am with everyone. I said, look, for these reasons, your fund is going to do really badly, even though it's an own the world fund, so to speak. And if you look at the performance over the last few years, it's still negative. So
I think so, yeah.
yeah, but anyway, that's another topic. Anyway, let's crack on with the main topic. So let's just quickly go through the things. Gary saw Elon satellites. Yes, it is insane. By the way, I have a very important package being delivered by DHL today, and I'm hoping it's not during this session. But if it is, Pips, my dog, will bark like nuts, and I'll have to leg it. It's my Starlink package. It arrives today. Woohoo! Can't wait. So, I mean, that's good for business, because part of running a good business is under promising and over delivering. So there was me thinking, I've been told it would arrive on Thursday, and then I got a nice text today saying it's arriving today. I'm like, ooh, even better. So I'll be going from 7 meg download and 1 meg upload to something like 100 meg download, which is awesome. Peter said, what's a Starlink package? It's basically, Starlink is the internet, a space-based internet company, or arm of SpaceX, so one of Elon's companies, and its goal is to beam really fast, low latency internet down to every square foot of the planet, which is handy, especially for my house, which is in a bit of a dip, so I don't get 3G or 4G, and I barely get bloody, normal, signal. Reese, okay, last Starlink question, then we got to crack on. So at the moment I'm paying £80 per month, once it starts, and it's between 50 to 150 meg download, a latency of about 30, so 30 ping, which is really good, or less. But over the next 2 years, it'll be going up to 1,000 meg download, and the price will reduce, which is just insane. So, yeah, anyway, let's crack on. Thanks for being here, everyone. So today we are answering a question in the WAP group, which is a great question. I'm going to have to move it over to my other screen here because I've got all sorts of weird apparatus. Apparatus? I don't know what's what. So it's from a lovely guy called Harbinder, and he said, hi everyone. In fact, what I'll do, I'll read out the whole question, and then I'll give my 2 cents, because I got a lot of 2 cents on this. He says, hi everyone, I'm really enjoying going through the WAP course and have a couple of questions regarding a business venture that I'm about to embark on. 1, I want to create an information product with one of my clients and try to push for a 50-50 split in terms of costs and profits. The business will be all in his name, I just want to split the costs and profits. At the moment he works with people in person and does well, and so I've decided to create an online version of his service in order to create and reach a wider audience. He is an expert in his field and will be the face of the product, and I'll run everything in the back end in terms of managing and marketing. Eventually we agreed on 60-40 in his favour. I don't have much experience here, so is this good? Or should I try and push harder for 50-50? We've planned out the course, but after watching some of the WAP videos, I'm thinking that it may be better to do what Siam Kid, or me, said, and run a few 6-week webinars, 3 perhaps, in order to answer more questions and fine-tune the product before finalising the final version. If so, should we run a survey monkey, and would we charge for the webinars? Thanks in advance. So the reason I'm deciding to go through it now is because the answer would be a friggin' essay. Oh, so it's a bulletproof coffee, Stuart, in case you're wondering. So let's break this down. So there's a lot to go through here. So hopefully, yeah. Right. So the first bit I'm going to break it down in order. He says, I want to create an information product with one of my clients and try to push for 50-50 split in terms of costs and profits. The business would all be in his name. I just want to split the costs and profits. So that's my first red flag there, mate. The first red flag is what's happening is that he would have full 100% control of the business and ownership of the business. So all the shares would be him. But what you're doing is you're splitting the costs with him, and I guess the profits as well. But what's happening is you're helping build his company, and you can end up being tossed by the wayside. And I mean, this has happened to me before. I've done so many deals like this, it's silly. And so the first thing is that no, that is a bad, don't do that. Obviously I can't give any advice, blah, blah, blah. Ah, Harvinder, you're here, mate, nice. So I'll go through all of this and then I'll open up for questions, etc. So yeah, do not do that. Because what will happen is that you'll build up his whole business, you'll share all the costs, you'll probably get some of the profits, and eventually something will happen and he'll go, see you mate, thanks, bye, don't need you anymore. Because one of the part of the nature of doing a JV like this is that because he's the talent, he's the front man, so to speak, and you're the back end person, you're going to be spending a lot of time to begin with setting it all up at the back end. But what happens once it's all set up, your job in terms of, you know, the amount of work hours required, Dwift filters off, scales back a lot, to the point where I've bought into some companies and saying, hey, I'm going to do this, this and this. I've done it all, set everything up, and then it's like I've got not much to do. And then like a year or two down the line, resentment kicks in with the other person because they're like, wait a minute, I've got, you know, Siam or you've got this much equity in my business. He doesn't do anything. But what they fail to realise is that the reason the business is doing really well is because all of the stuff that you implemented to begin with. So, and then if it could be, bloody, I need to stop drinking coffee and talking, because then you could be in the weird situation where you have to look busy. I remember back in the Air Force, I sort of perfected looking busy. There was one squadron where I was like really lazy. This is towards the end of my career where I really just didn't give a shit. And I wanted to basically project the max amount of looking busy with the least amount of effort. And so I did the power walk every morning. I think it was like 7:30. So what happened was, what I knew is that the senior officers of the squadron would have their sort of senior meeting or whatever at like 7 o'clock. They'd finish by like 7:30 in the morning, and they're all on the top floor. Or it's a 2-story building, so they're on the second floor. And what I would do at like 7:30, as they're all walking out the meeting to their offices, I'd be strolling down the corridor with a newspaper like the Times and under my armpit, cup of coffee in my other hand, walking down and going, morning sir, morning sir, morning sir. And every day they would see me strolling down that corridor bright and early before anyone else. And so it was an exercise. I just wanted to project the maximum, I guess, bullshittery in terms of, hey, Simon's always here. He's, you know, here bright and early. And then what I would then do is go and bugger off and play golf for the rest of the day. So, yeah. So, but how I see things now is that, I mean, that's incongruent to who I am. Like, I'm a big fan of only doing things congruent to your, I guess, yeah. So I just don't like doing stuff like that. Anyway, that was a bit of a tangent. Sorry. So the next thing I wanted to talk about. In fact, let's carry on with the percentages. So this is interesting. So there's a number of things you could do. Okay, so this is one option. What you could do is you keep his existing biz as it is. Okay, so let's say his biz is company X. So nothing, you don't touch that business. He maintains that's him. But what you both do is set up another company where, in fact, we'll talk about the percentages in a minute, but let's say 60-40 as you agreed. So he has 60% equity, you have 40% equity, but it's a brand new company, okay? So you have the shares of that company, etc. And you will both contribute an amount of money, or not necessarily money, you'll contribute something to that company. So you could put up some costs, some money. I mean, it's simpler if you put 4 grand in, he put 6 grand in, and then, are you joking? That is, the cleaners opened it. Hey, Starlink's here, amazing. So you both have, so I need to concentrate more. So you have this new company, right? 60-40. Now you can contribute some money or some time, and he contributes some money and some time. It's up to you what you both contribute to it. I mean, it's a lot cleaner if you put 4 grand in, he put 6 grand in, or same percentages, whatever amount, and then you use those funds to build out the business. It's a lot cleaner. I mean, you can do it where you both put, like a brand new company needs share capital. So typically, if you set it up at 100 shares at £1 each, £100 needs to go into that bank account. So he could put 60 quid in, you put 40 quid in, but you then also put a whole bunch of your systems. He could then gift some of his IP to the company. But I think I would keep it a lot cleaner than that. I probably wouldn't do that. Like I said, you can skin a cat a million different ways like this. Okay, so keeping it simple. He has his company, you both have this new company, and what you're then going to do is build out this company here. So you build all the back end stuff in this new company, because remember, you have equity in this. So I'm always obsessed about leveraged work, okay, where you do work once and then you reap the benefits of it. Whereas if you did all of that to his business, that's not really that, or I guess it is leverage work, but it's work that can bugger off. Whereas if you put all the effort up here, you own this company. He can't just bugger you off. And then what happens is every single month, this company will invoice. He will invoice you. Okay, so he will invoice the new company for services rendered. So it could be like a licensing fee. Where obviously he's probably very protective of his IP. I mean, if he's an expert in his niche and he's probably got some systems and stuff that he doesn't really want to give away. And so so what will happen is every month this company will effectively rent his services and his expertise and stuff like that. But what happens is and he'll like this as well. So whenever I'm constructing a deal, it needs to be a happy. Now there's not really such thing as a win-win, because with most deals, especially if you start negotiating, there is no win-win. It's like basically both of you start compromising to the point where you both compromise enough where you're like, yeah, okay. So I don't like win-win situations. I like happy situations. And so this will help him in this deal, because he'll be like, oh, cool, I get to keep my content. I like that. And so you need to look for happy deals. So that's that. And then you then start building this company. Now the crazy thing is, if things go well, this company is going to then grow far larger than this business over here. And so it gets to the point where the better you do, the less likelihood of him screwing you over, because with this deal, there is one tail risk there where he could go, actually, no, I'm going to stop leasing or licensing my IP, etc. over here. And so, however, if this business is booming, this new one that you're running, he won't do that, because all of his income, where will it be coming from? It'll be coming from the licensing agreement. And then eventually what happens if you do this really well is that this company then just goes up and gobbles this company up. And then guess what? You now own 40% of everything. So, well, not 40%. You'll be diluted a bit if the big company then gobbles up the original company, because he's got 100% of this and 60% of the top co. But at least you'll then be getting your mitts on the other stuff. So that's one thing. And also, I do not like 50-50 agreements, as in equity holding. It nearly always leads to pain and error and sorrow, and I've seen so many businesses go wrong where 50-50 partnerships just bugger off, or they just stop liking each other, etc. And yeah, and sometimes in a 50-50 company or partnership, if you don't have the correct I guess mitigations in place, you'll have to wind up the company, and you have a thing called company deadlock where both directors can't agree on anything, so you have to wind up the company. But I think that's from poor setup, because you shouldn't actually ever end up in that situation if you have the correct shareholders agreement in place. So so in terms of, I'm going all over the place here, but it'll hopefully sort of circle back round and make a bit more sense. So let's just say, fast forward, you now have this new business where you've got 40%, he's got 60%. You then need to look into a shareholders agreement. Now, I personally wouldn't even bother going to a solicitor to do it, because what they'll do is they'll charge thousands of pounds. They'll come up with like a 20-page shag shareholders agreement, and even if things go wrong, it won't protect you. Honestly, I've talked about this in length with all these daily wealth chats, that where contracts mean jack shit and they don't protect you, even if you have an airtight one. I have been screwed over so much over the last 10 years with airtight contracts, which I paid a lot of money for, so it's not worth the paper it's written on. So I apologise if you have watched some of these previous videos before, but I have to talk about the shit list and fix list, because that is the foundation of a good shareholders agreement. So what I do is I get a notepad, an A4, you probably can't see this, God, it's on portrait, I have to do this. So I get an A4 piece of, I get a notepad, so you have an A4 piece of paper on the left hand side. So basically open up a brand new clear, 2 pages. And on the left hand page, I title it shit list, underline it, and then split that page in half as well. So you then go me, underline, then you, underline. And then on the right hand side, you call that the fixed list. Again, you split that in half as well, me, underline, then you, underline. And what happens is, on the shit list, you then literally just vomit out all of the fears and trepidations that you have. So you can say, oh, I'm scared that you'll do this, and you'll screw me over this way, this way, this way, this way, and I'm scared that this will happen. Cool. So you really lift up your skirt, and I got in trouble saying that. You've lifted up your kilt and shared all your issues, and then he'll then be more open to sharing all of his concerns, or I think it's his, he, she. I think you said it as a he. Yes, he. And then he'll go, okay, I'm worried that you're going to do this, this, and this. So on the left-hand page, you have a whole page of shit, and fears. So on the next hand page, it's the fixed list. So you then go through each line by line, going, and then you put in a clause to mitigate each fear. I'm scared you're going to screw me over because of, in this way. Cool. Well, what's the fix for that? Well, we will do this, this, and this to make sure this happens. And then you spend probably a couple of hours going through every little clause, and then before you know it, you then have a page full of fixes. And this is the foundation, this is your 10 commandments, so to speak, of your shareholders agreement, and you'll know exactly where you both stand. And then after you've done that, you then get another page, and then you look at your accountability spheres. And so this is where it's really important that when I talk about accountability spheres, what you should do is write out the typical org chart. So you have director, ops manager, head of sales, head of IT, head of marketing, head of tech, head of content, head of whatever. So think of head of video, I don't know, whatever is relevant to your business. Okay, so in this org chart, you'll have a whole bunch of head of blah, 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 blah. And then even though this is a 60-40 partnership, it doesn't mean it's 60-40 in everything. And so this is very important. A lot of people think, oh, I've only got 40% of the business, means I don't have a say in anything. That's rubbish. That's bad myths and misconceptions being thrown out there. You've got to look at it in two different ways. The shareholder stuff, the equity holdings is one thing. Okay, you need to park that. And if you do the shag thing properly, then this is all about who controls what. So what you then do is go, okay, he's going to be director at the top. Okay, so he's the head honcho. Yeah, he has, I guess, final say on lots of things. But when it comes to the specific things, so let's say head of marketing, that's going to be you. And so what happens is anything marketing related, you have final say. So he'll say, oh, I think this happened. But if you disagree with him, because on the shareholders agreement and your accountability spheres, because you have final say on anything marketing related, you win on that decision, so to speak. So yes, you've got this massive org chart. All you need to do is fill your names in each one. So he'll be head of, banking, head of blah, blah, blah. And that way you know where you stand. Now what you then do with this normal org chart, you draw spheres around them all. And what you'll find is, head of marketing, head of sales, they're similar things. And so the sphere will interlap, okay? And so you have like these Ikagi type things in between. And that is where I think gaps can sort of errors can slip through the gaps sometimes, and so if they're not overlapped, so if there is an overlapping, you need to sort of figure out, okay, is it a marketing issue, is it a sales issue? You don't know, but it's something that you need to talk about, and then before you know it, you've got this big old accountability spheres. You have the shit list, the fix list, and at the end of the day, your shag really shouldn't be more than sort of 4 pages long. Honestly, my 4-page shags are better than my 20-page shags. Because what happens is, if you get a solicitor to create a shag for you, they will effectively have to justify their own existence. So they'll put in, a 20-page shag, and a lot of that is bumped because they're like, okay, well, if this is, I need to plug up this hole, this hole, this hole, this hole. And if you then took that, solid shag to another solicitor and say, hey, where are the holes in this? That solicitor will then have to justify their own existence and come up with all sorts of crazy, holes in the thing. And so, and this is what happens. They just, you can bounce. You can get one shareholders agreement and say make it airtight, and then you get an airtight. You can give it to 10 different solicitors, and they'll all find holes in it. There's no such thing as a completely airtight contract. So that's that one. Talking about the equity splits. Okay, so let's move on to the next part of your question. Where you say, at the moment he works with people in person and does well, and so he decided to create an online version of his service in order to scale and reach a wider audience. Cool, nice. So what he can do, see, this is another reason why it's good having those two businesses. He probably will feel very reluctant to give you any of his profit with the one-to-one personal stuff that he does. Okay, it's just a content creator thing. It's like, why should Harvinder make profit when I'm going out to do a one-to-one or a speaking gig with someone else? And so what you can say in terms of when you're sort of giving back and forth the perks and stuff is go, look, any one-to-one time, that's time that you're spending, keep it in your business over here. So all the revenue and stuff is going into, so all the online stuff is going into this new business where you have 60-40. Should I try and push harder for 50%? No, just covered that. Okay, so in terms of the course content, doing one-to-one stuff and online teaching stuff is actually a lot different. I also started out doing a lot of one-to-one stuff and thought, I could just put this into an online course and it'll be fine. But people learn differently online to when they are one-to-one. I found you get the best results when you're doing one-to-one, especially in person, because they can't skim read when you're sat right next to them. Whereas online, if you're doing an online course, people are always distracted. They'll probably skim read or skim watch the videos. They will probably be looking at their phone whilst they're looking at a course, and they'll just be missing stuff left, right and centre. So do my online webinar technique, mate. For those not familiar with that, what in a nutshell, I don't want to go, crazy with this. What happens is you create a little survey, a quick, 7-question survey, and say, hey, and this survey is like, would you be interested in this sort of online course? If so, what would you like on the course? What would you like to learn? What price would you be prepared to pay for this sort of stuff? Would you like it video or audio or pictures or song, dance? I don't know. Yada yada yada. And then what you do is you drive a whole bunch of people to fill out that survey, get at least 100 unique fills of the survey, and then you analyze all of the answers from that survey to see what people like. And then a week later or a few days later, you contact those 100 people, go, hey, thanks for your feedback. We now have this online live course which covers blah, 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 blah. And those things are the things that people said that they wanted to learn. And also, so this goes to your pricing question. So the pricing for your first, these are simply research and development webinars. So you can make them free or you can make them extremely cheap. Hell, make it 50 quid, I don't know. It's your call, but the reason you're doing this is that you want to be paid to create the content. So yeah, you can make it 50 quid and it's going to be a 6-week course, and every Wednesday at 7 o'clock there's going to be a 2-hour session or hour and a half session. And so that way you only need to prepare for the first week and then you're just jotting down all the questions and stuff that they ask during that first session, and then what you then know is how to then make week 1 session better the next time round with the next cohort. And so yeah, you need to timestamp all of the questions, so that way, if they go, why does this happen, and they ask that on the 7th minute of the course or of the webinar, you then need to make sure for the next time you do week 1's webinar, you've answered that question before the 7th minute, so that they don't ask that question. So every question someone asks in a course is simply a knowledge gap which you have failed to adequately answer as a content creator. So that's the way you should look at it. It's just data, it's pure data, giving you pure feedback. Don't take it personally. If someone goes, I still don't understand it, don't take it personally. When someone says, I still don't understand it, Siam, or whatever, you should not think, oh God, this person's an idiot. It's you that have failed to teach adequately in the correct language. That's what that feedback tells you. So going back to the next thing you said, what else did I put? And then once you've done the full cohort, so let's say you've done your 6-week course, then you need to get feedback and then get testimonials, and then every course thereon will be more expensive. And then you'll have 20, 30 plus testimonials from it eventually. So that's how you're going to do it. Now in terms of the split, so you've got this new company up here, obviously, and you're doing all the back-end work. So you're setting up the CRM, the landing pages, the ad, the funnels, so to speak, all the marketing, full stop, and all of the wizardry. So make sure you use Zapier to, so all of the different softwares are talking to each other. Make sure you have your dashboards, so you know what business metrics, or in fact, yeah, he may not be aware of all the relevant business metrics. So use the stuff in the WAP and then set up those dashboards. And then what you need to do is have cohorts. So what I do with one of my businesses, which works really well actually, is I'll have a January cohort, a February cohort, etc., etc. And so what happens is, let's say it's a 2-month trial with whatever you end up doing. So let's take the January, February, March cohort. So you'll open up on the 1st of Jan. You do marketing, and then you stop the marketing on the 15th of Jan. And we also close the door for that cohort. So what happens is that you have the January cohort, and then and everyone's in there on the 15th, okay? And then let's say it's a 2-month trial. You then start the 2 months from the 15th of Jan. So what actually happens is you end up giving like a 2.5-month trial, because what you're then going to do is close that group on the 15th of March. And if anyone wants to join, after the 15th of Jan, let's say, they go, the landing page goes straight to a waiting list. So what then happens is that on the February group, you open the doors on the 1st of Feb, and then marketing, etc., up until the 15th of Feb, and then you do that. And as you do this, what you'll find is that your waiting list will grow and grow and grow. So the waiting list, so it's the 15th, so today I'm actually closing one of the free trial groups. But it's interesting. What month is it? It's March. The March cohort, which, as in the new March cohort, I've done no marketing for that this month, as a bit of a split test. And it's crazy. We've had like 200 people join in the free trial and have done zero marketing. Because what happens is people, your waiting list will naturally, organically grow, which is pretty handy. So that's the trial thing. I also want to throw a massive spanner into this now and say that there's an alternative to everything I just mentioned over the last half an hour, and that's the LORA, the low risk acquisition method, which I've spoken about in length on some of the other mergers and acquisitions videos. Now, before I go any further, does anyone here on the Facebook Live right now not know what my low risk acquisition method is? I don't want to bore everyone, you see. I know there's a lag on Facebook Live, so I'm just going to shush for a moment and see what questions pop up. Do you all know what my low risk acquisition my LORA method is, or not? You can hear me, right? I see no questions popping up. Facebook Live absolutely sucks. At some point, I think I'm going to have to move everything to Zoom. That way I can do some doodles and stuff, because I think it's like a 30-second lag with Facebook. Right, I see no comments, so that means... Oh, so Ed doesn't know. Okay, cool. Okay, so I see a few people say they don't. Screw it, let's go through it. So very quickly, okay, some do know. I guess it's I don't know, but Maris. Okay, that's fine. So I'll keep this short, like 5 minutes. Realistically, this takes several hours to explain in detail, but I'll give you the broad overview of it all. So I've lost a lot of money doing mergers and acquisitions, like buying companies and putting money into businesses and stuff like that. And so eventually I figured out, I basically combined my trading knowledge with M&A and created a way which I originally called it the NORA, the no risk acquisition, which people don't like the term no risk. I mean, really there is no risk in this, but I've now called it the LORA, the low risk acquisition. So what happens is, Harvinder, what you could do is go to this person, let's say it's company X, and go, hey, so what I'd like to do is come and work with your business for the next 2 years. And what I'll do is I'll do everything I can. I'll add all my systems, marketing, I'll help build everything up. Before you do all this, you ask this person what he thinks his business is worth, okay? And try and work out, I mean, you want 40%. So let's say you come to an agreement that, 40% of his business is worth, I don't know, 20 grand, 50 grand. I don't know what what revenue is doing at the moment. So let's just say 20 grand or I don't know. So you can then basically say, look, I'm going to work with you, and what we'll do is, if I can double your turnover or double your profitability over the next 2 years using all my systems, doing the online course, blah, 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 what I'll then be able to do is have an option to buy. I'll be able to buy 40% of your business for this pre-arranged price that we've just agreed, 20 grand, 50 grand, whatever it may be. So, so that's the first part. So if all goes well, you've basically doubled the size of the business, which means that the 40% that you've agreed at X price means you're effectively buying, £1 coins at 50p, if that makes sense. So let's use some actual figures. So let's say 40% of his business is worth 50 grand. What this means is, if you double the size of the business, that means your 40% is now worth 100 grand. But you can then go in and buy that 40% at 50 grand. So that's the first part. Now the second part is that you need a retainer to make it low risk or no risk. So what you can then do is say, right, you can actually just map it up. So let's say you use the 50k thing. So 50k, so it's 25 grand a year. Divide that by 12. Yeah, so call it 2,100 quid a month. So you could come up with a retainer of £2,100 a month. So what happens is that he will pay you a consulting fee to cover your time of £2,100 per month, and with that you'll be providing everything. You'll be building websites, landing pages, blah blah blah, and you can sort of price it so that, you know, if he was going to pay for this elsewhere, it would cost a lot, you know, a lot more, blah blah blah. So what then happens is that at the end of the 2 years, if all goes well, you then pay him the 50k, but that 50k is basically everything that he's paid you in that retainer, so you're simply just giving it back to him. So then you end up with 40% of his business for free. Or what I like to do is I make sure the retainer is actually more than what I'll end up paying back. So that's why it's low risk. Now, if you don't get along with each other, then nothing happens. You just rip up the contract and walk away. And so it's a good way of dating before you get married. Whereas with M&A, a lot of people get married on day one and then end up having lots of divorces. In terms of business divorces, I mean, if you look at my company's house, I mean, I've got it's weird. Company's house is a mess for me. I think the last time I checked, there are 4 Siam kids on company's house. There's Siam kid, Siam Richard kid, whatever, and each one of these Siam kids on company's house has weird, you know, has a bunch of different businesses. Now, back in the day, I used to buy lots of distressed businesses, trying to turn them around, thinking I was some Theopathetus. But distressed businesses are screwed for a good reason, because they're effed, basically. And so what happened, I ended up buying a whole bunch of distressed businesses, couldn't turn them around, ended up having to liquidate them. And so I left a trail of destruction on company's house, which a lot of my trolls seem to like, oh, look at Simon's company's house. And I'm like, well, you know shit, if you try and buy distressed businesses, that's what happens. So this is why the LORA is great. You are effectively a shadow director, legally though, and there's no mention of you on this business. So if things balls up and you walk away, there's no like company's house trail of that. So yeah, it's a good way. And then if you want to get married, then when you exercise the option, then you're then officially a shareholder. But that's just a quick overview. What I have done is I put all of the M&A stuff in the WAP portal. So if you scroll right to the bottom, there's a mergers and acquisitions module, and I think over time I'll be putting a more precise, detailed version of the LORA, because it's beautiful. You can do so many things with the LORA. So Harvinder, are you still here, mate? Did that help? Do you have any follow-on questions from what we covered today? I know I've gone all over the place, but that's just my silly head. I tend to do that. Cue the Facebook lag. And whilst you're answering that, Harvinder, if you're still here, that's the thing with Facebook Live and Zoom. That I've been trying to weigh up that seesaw, because Facebook Live is great because I do the live, it'll then pop up on my friends' feeds, and I'll get all sorts of people joining which I haven't seen in years, like Roger Ball, mate, Roger, it's been years. I've seen there's loads of old faces, and that, you know, people that are watching this which normally wouldn't. Whereas if it was like a Zoom thing, it's just a lot harder for people, and people are less likely to just jump in it. However, I think I may have to actually just move to Zoom, because there's so many things I want to doodle. It's much clearer if I can doodle stuff. Cool, okay. I'm glad that helped. So does anyone here have any other questions about anything? We have gone on for about, I can answer another couple of questions whilst we have the time. Oh, for the survey, should I use SurveyMonkey? Yeah. Use SurveyMonkey or typeform.com. I've used both. But SurveyMonkey is simple. However, the UI for typeform.com is better. It's your call. Perhaps get used to maybe Typeform. It seems to be taking up a bit of a sort of market share from SurveyMonkey. Any other questions? Alexander, do you answer a question about crypto today? I can answer a couple, yeah. So just to hit me. And no, I'm not going to give you my top 3 crypto picks. I get that pretty much every day. Just watch the Kryptonian portfolio video on YouTube. Any other questions? And whilst I'm waiting for questions, Harvinder, another reason why this is such a good idea for you to join in with this expert, so to speak, is that you'll be able to create for him and for yourself a really good residual income stream. So whereas if he's doing one-to-one sessions at the moment, there is no residual or recurring element to his business whatsoever. He's basically working for time. He's expending time for money. Whereas if you have a course and then memberships, etc., then yeah, you've instantly increased the exit multiple of his business. Because as an expert, him doing one-to-one stuff, if he was ever to sell his business right now, he'd at best get 1.5 exit multiple, which means he can only get maybe a year's worth of profit up front, maybe 1.5 years. But the moment you have an online course and you have a payment plan method, so it's better to have a payment plan business than a subscription-based business. But the moment you have one of those, even if it is a subscription-based business, your exit multiple goes to 5x straight away. So you could, let's say he's doing 100 grand profit at the moment, at best he could sell his business for 100k. If you converted the whole business to online course and a subscription or payment plan business and it's doing 100 grand profit still, because you've got a 5 times exit multiple, the business is now worth 500 grand. So he's got a 5x uplift there. So yeah. Peter Walton, do you own any antique investments? No, I don't. One, because it's a place, unless you're gold and silver, I guess is antique, but it's a bit different. So I don't have much or any knowledge in the antique world, so I don't tend to play with things I really don't understand. Two, what I've found with my cursory diving into antiques is that the ROI, or the ROTI and the ROKI, are pants, in my opinion. So the return on time invested and the return on capital, it's the ROTI which is the bad one, the return on time invested. And I always meet people say, oh yeah, I've got this Rolex or this old car I've had for 10 years and I've just sold it for 50% profit or 100%, let's say 100% profit. I've doubled my money in 10 years. Well, what is 100% divided by 10? 10. So all that's happened is you've just crystallized a 10% yield, which is pants. So I don't like antiques for that reason, and I don't really want to hold something for 20 years or 10 years. Now, I do understand that you can buy a whole bunch of things at the bottom of its depreciation curve to then maybe do a quick flip, but then you have to look at the ROI you'll get for that quick flip based against the risk that you're taking. So personally, I'm not into antiques, but I have mates that love it and they do really well. Horses for courses. Emitai, I think, I'm sorry if I pronounced your name wrong. Emitai. People call me Siam all the time and it pisses me off. All my life people always mispronounce my name as Siam. I'm like, no, it's Siam. So I'm sorry, Emitai. Anyway, could you Facebook Live with Zoom and share the screen when doodling? I guess you could. I could actually yeah, maybe. Oh, mate, thank you. That's a really good idea. What I could probably do is turn the camera around so it's facing my computer screen, so it's capturing the doodles. Yeah, I'll have to have a little play at that. Good idea. Alexander, is it too late to jump into similar Kryptonian portfolio? I bought a couple of ETH, but they do not grow as fast as some of the other tracker coins, and I'd like my portfolio to grow faster. So we're only probably 3/5 of the way into the bull market. So when you look at the logarithmic regression band and stock to flow models, the peak of this cycle is around January. So I'm remaining very bullish until then. We also don't have the altcoin cycle yet. So ETH hasn't started growing yet. All that's happened right now is Bitcoin's blasted off and it's dragged, just natural dragging of everything else, Ether and everything else. The altcoin cycle is only just starting. So I'm extremely bullish with Ether. We haven't seen anything yet. So I wouldn't say it's too late. Harvinder, what's the difference between a payment plan and a subscription business? We're planning on a monthly subscription side to the business. So there's a little nuance there. So a subscription-based business means people are paying a monthly subscription, obviously, but they're not tied to anything. They can leave whenever they like, which means it makes your yearly and or average lifetime value of a customer metric really hard to choose. So I have, so one of my businesses is still a subscription-based business. It's called myfairypenpal.com, and trying to work out the average lifespan of a client is really hard, because you have a whole bunch of customers that last 1 month, a whole bunch that last 2 or 3 months, then a whole bunch that lasts 5 to 6 months, and you're like, okay, so when I'm trying to find what is my average lifetime cycle value of a customer, it's a bit trickier. And also you don't, and it's really important when you're doing the marketing. So if you're marketing like Facebook ads for any subscription or payment plan type business, the minimum you're going to start off with is paying twice the amount that it's going to cost. So for example, if you're making, let's say you're charging 50 quid a month, so that's times 12, that's 600 quid a year, you will most likely be paying about £1,200 to acquire one customer, which is nuts. Yeah, you'll probably be paying anything from 500 to £1,200 to acquire that one customer. So you're basically breaking even if a customer stays with you for a year, and that's where you'll start off with. Which means if you do spend all of that money to get a new customer, I don't want to be hoping that they stay for a year just so I can break even on that customer. I want to know that they will stay for at least a year. So it's better to move over to a payment plan business. So what's happening is that they're still paying the same. So yeah, they'll be paying the 50 quid a month, but what they're doing is they're paying for 12 months membership. So it's a slight nuance. So they're paying for a £600 membership up front, but they can spread it over 12 months. So it's basically 12 times 50. Or you could do it like I do with some of my businesses, where they can pay for 10 months, 12 months up front for the price of 10. So there's a bit of a discount if they pay up front. But if they want to pay monthly, then it's, like if you look at one of my businesses, it's £500 a month times 12 if they want to pay monthly. So that's a total of £6,000. Or if they pay up front, it's £4,800. So basically, they're getting a bit of a discount by paying in lump sum. But what do I now know? When I get a new customer, I know that they're with me for a minimum of a year, and that helps with my marketing. So yeah, go for the payment plan stuff. And also you'll get a higher exit multiple if it's a payment plan business compared to a subscription-based business. So you'll probably get a 5.5 or 6 times multiple if it's a payment plan. And the beauty of it is when you have a customer that's with you for 12 months, you then have 12 months to basically give as much value as you can. Whereas if someone is only with you for a month or so, they may have, created a knee-jerk reaction or opinion of you. And sometimes, especially for me, I'm like Marmite. Sometimes people instantly hate me. But then if they spend a bit of time and listen to the things I have to teach, I can sometimes win someone over that hates me into then becoming, actually, Siam talks sense. So that's the problem with Marmite people. You need time. It's a bit like, sorry, that's a crude analogy. I've got to be careful what I say these days. So many pansies everywhere. Whoops. Right, let's move on. Fame says you can Facebook Live, Zoom, then share the screen to your tablet when it's all connected. Thought that's how you were doing already. No, I'm not. I'll have to look into that. I'm not a tech wizard. Mate, can you just remind me once and for all, how do I say your name? Is it Fami or Fame? Or is it Farmy? I'm so sorry. I meet so many people every day, online that is. I will carve this into my memory. If you can just type it out phonetically, that would be grand. Right, thanks for another half an hour session, which has moved into 48 minutes. I will see you tomorrow, and I don't know what we're going to talk. I think it's just going to be a generic Q&A tomorrow. So I'll see you at midday tomorrow. Hope that helps, and I will close this session once Fame, okay, so that's how I say. Sweet, I'll remember that, Fame. I'll just carve into my head, you are like a celebrity. So fame. That's I have to remember weird stuff like that. So now I'll just see you as a celebrity, then I'll remember your name as fame. So pictures. That's how I remember things. Right. I'll see you soon. I've got to shoot off. I've got to get my fast internet set up. Woohoo! And I'll see you tomorrow at 12. And for the traders here that are in the RT community, I've got trading pub at 2 o'clock today. So see you there and then. Gotta love you, leave you. Bye.